This is Justin Pulitzer. This is my weekend review for Sunday, October 11th, 2015. So this week we had some interesting info from the Fed. It was more of a confirmation than I think anything new, but I do believe that it really does firmly cement that 2015 is off the table in terms of rate hike and potentially open the door for QE4. So the Fed said that they're worried about a stronger dollar. They're worried about China. But the big key here was that they said that they don't see themselves reaching their 2% inflation target until 2018. That's really, really long from now, considering we're not even in 2016. So the Fed funds futures don't even show a touch of a Fed funds rate nearing 50% probability until March 2016. And I don't see why, if the Fed isn't reaching their mandate of their 2% inflation, why they would find the need to hike even now before 2018. If that's really the case, I would imagine that, we're going to be playing the monitoring the data game, of course, because if anything did happen, they could revise that. But the Fed has been overly optimistic on growth for a while, and maybe they're again overly optimistic. We'll see. I proposed in the Periscope on Friday, the link to that will be in the description below if you just click the description box and drop it down, that the quickest way for them to reach their inflation target might be to kind of press the accelerator a little bit, and that would be in the means of QE. So where does that leave us, and what does that mean for the market? So here we are in SPY. I know my SPY chart has a lot of markings on it. I do propose a lot of levels. And you can see here, I had said in the last week's review that I thought we were going to come down and retouch into the 87s. We did. And then I thought we could rally back up to the range highs into the 99s and maybe a little bit higher. And that has happened as well. We have broken one of the downtrend lines, which is very good if you're bullish. We've gotten up to a 61.8 Fibonacci retracement of this big range from the high to the low. If you back that back out, you have a 61.8 fib. And we are now starting to get close to coming into some range areas. You can see that I had marked off the 197.86. We are firmly into there. Once we broke into there, we got up to another one here, which is the 201.90, which was an old reference. That was the old high in SPY before all of this sort of topping action. And it's possible that we want to come back up a little bit higher and retest really to the range high here. And if you see on my chart, I have some potential other upside levels where we could potentially see the market go, and also possibly for a right out short, RORO. So if you see this area, this is really where the more major breakdown took place. You can see this was all kind of lighthearted until we broke these areas. Here you had the failure kind of at the range high, a bit of a pullback, a more steep pullback. Look where that stopped here at the 204.12, and this low here, which was the 204.11, basically those double lows. And once we had the close below there, this is really where the bottom fell out of the boat. So it wouldn't shock me to see us to come back up if we want to rally a little bit more into 204s, potentially 205s, and maybe squeeze a little bit up to close to 206s and 7s, because you can see there's a more dominant downtrend line there. There's also the backside of this old up channel that comes into play there, and then also the top of this potential new green channel that we are in. They all have a confluence up here around these 205s, 206s. And like I said, I think a lot of people who got caught in this are going to be anxious to get their money back. This is really where the dead bodies lie. You can see, look where the volume distribution really picks up. It's really at this node here. It begins here in the 204s and really starts picking up in the 205s. I want to just show you one thing with, not to get too wonky on you with the Fibonacci's, the 78.6 is really where we got caught, the fib caught it on the move back down here. So if you take a look, on the way back up, the 78.6 fib comes in around 207, and look where the major body of this begins, and look where the the breakdown sort of began. It could be even higher into 207s. So it's sort of around and around she goes, nowhere where she stops, no one knows type of a thing. But I do think that I kind of know, and and I do believe that the 204, 205 is going to be some area of resistance and potentially into the 206s, and maybe if we press into the 207s. The key here to me is this was the Fed minute day, and it really became a Fed day because the minutes were really so dovish. It took a few minutes for the media to pick up on that, but I said immediately that this was really amazingly dovish. And you can see it really took off once we broke over the flagpole high, which was really here. This is really where the most of the action took place. You can see there was a little bit of action above there, but the previous day had closed there, and then once we breached that high, that's really where the squeeze came. So if there is going to be and then Friday was really rather bullish. You can see it was a doji, the body of which closed above the body of the prior day. So it really was, this was a really bullish kind of consolidation day. Actually, the most bullish thing the bulls could do is have another couple of days like this and then take off again, so it becomes a little bit more sustainable to consolidate this big move. If we do wind up coming back down, I do see obviously the 99.84 being key, the 50-day moving average, which is just a little bit lower, in the 99.46s. And if that gives, then I believe we could potentially fill this gap to 195s. At that point, you're kind of on your own if you're playing short. I would say that this here should be kind of the max pullback here, at least if you're kind of swinging it. If you're looking for a larger play, like for a breakdown of really a complete breakdown of range, I'm not necessarily so sure you're going to get it so quickly. That would be the logical progression if this is considered a bear flag. I have proposed in previous videos, I do believe that we could go back down and retest the 2000 and 2007 peaks down around the 155s and 157s with regard to SPY. But that isn't really going to be playable, in my opinion, unless you really see this range fall apart. I just believe we are in. Someone had asked me on the stream the other day what I think is the market's doing. I said I just think it's sort of play the range until the range stops working. So we are now coming into the upper end of range. I do think that it's possible we could traverse back down to the mid part of the range and maybe even the lower part of range. If we do lose these double bottoms here, I believe we'll see the 182s and maybe even still below. I believe this would be an amazing short, and it would be a complete cascade event to the move lower, because you really shouldn't see this again when you have double bottoms like this that hold so precisely. So that's my theory. I do think that, like I said, potential move back up into the downtrend and into these more sort of prominent volume profile references, or a pullback earlier on in the week that could get us back to the gap fill. I'm going to cover the other two indexes, and then I'm going to talk about the keys that I've been highlighting. You can see this is sort of, IWM is kind of into the downtrend. So this could be a precursor here to some weakness. And maybe that gets the fill down to the 110s. I like that if you want to play put ratios, like you buy something up here, sell 2 times as many down here. That to me would be a good trade. If we do start breaking here, though, like Monday, if there's like a gap and go type of thing, it could really catch people off guard, because look, we did close above the 50 and we closed right below the downtrend. So if there's kind of a gap and go, it could get you really back up into these reference highs here around the 18s. If it does pull back a little bit, you know what I'm thinking. I'm thinking we might want to retest sort of into that gap area. The Qs have been kind of the relative strength. They never took out the range low. Let me show you on a larger time frame what I mean. If we go to here, there we go, 2 years daily, you can see, other than the kind of the flash crash and the subsequent like higher low, most of the bodies in the time has not been spent below this kind of breakout in range. So the Qs have been showing a lot of relative strength. They are, however, coming into some downtrend resistance and some price memory of some kind of dead bodies up here. So that is something to keep an eye on, particularly earlier on in the week. Like if there is a failure here, maybe it does come back down. If there is some kind of a breakout, like if Apple gets jiggy or something, maybe, and Google, maybe that brings that back up over the all-time, the downtrend from the highs. So what I look at when I determine where I think the markets are going is I first start out with the VIX. And you can see we had the kind of super spike here on the flash crash that took us up into new highs. And then we've kind of calmed down a little bit. And it's been holding key levels. You know, we had the bounce here of the 25s. Then here the 22s kind of supported a little bit. Now we're coming back down. We retested into the 17s. It bounced. We got up, up a little bit higher. And now we're kind of back below. I think this is kind of going to be what we might look like here for a little bit, or something even like this, where we could come back down and retest into the mid-range low and then kind of get a little bit choppy again. I think that the 15s here, 14s, 15s are probably going to be the range low if we do see continued weakness here. You can see it's been multiple days down. They'll probably find some support mid-range in here. So that's sort of what I'm thinking. But for the key for the market to go higher, you need to see a lower VIX. Obviously, a higher VIX means the market's probably going lower. UUP, I've been saying for a while that this is one of my biggest concerns, that this is just a big bull flag waiting to kind of break out to the top. I do like here that it was starting to make higher lows and equal highs, which was starting to look like we could have seen a pennant breakout higher, but it instead snapped lower on these really dovish Fed comments. The fear that I would say that bulls should have here is that these have been hammers and it hasn't really been going down with a lot of conviction. Like you're not seeing these kind of cascading bars lower. They're just like bottoming tail dojis coming into reference supports. That said, if anything below this uptrend is suspicious, it could come down significantly lower, and that would mean a higher stock market. If this does kind of wind up being a failed breakdown and then break out, kind of comes back up, the market's probably going to get itself hammered. TLT. Somehow the media has said that higher bond prices, meaning as this goes higher, the market should drop. That's ridiculous. We all know that low interest rates are good for discounted cash flows and PE multiples for stocks. So this kind of rallied up and it's just been kind of holding high and tight. I propose that we could be in a new channel. We'll have to see how that plays out. I just connected these lows and then kind of artificially used this high, but we'll see. Anything above the 123.15, I think that there's chances for higher prices. We are a little bit lower into the mid-range here. This really is where the rubber should kind of meet the road to support, somewhere between the 50% and look where the 61.8 would come into play. That's the 120. So if we were to have a couple of more days down, I would be interested in buying the 61.8 for a right or right out trade against the channel low. I think that would be a very, kind of a high probability. And then if it kind of snaps, you just get out. So, and then you could always reverse short. But this really, to me, is where we should support if we're going to stay in that kind of bull range. I know this is also a little bit more controversial. I've said for a while I think oil is trying to bottom. You can see that this is the USO. This is a proxy a lot of traders use. We haven't really kind of broke out of the flag here yet, but we are making higher lows and coming back up. If you look at the real kind of oil contract, that has already kind of started to break the pennant. We looked above it. You could see this was the range high, and now we're kind of closing above there. So I do believe that we could see a move back in oil to fill up this gap here to 56s if if the market gods kind of cooperate. We have some resistance here in the 53s, just on a volume. That's sort of where a volume node ends. But I do believe that is possible. Longer term, I think we can see 75, but I don't want to get into that because it's not going to be really relevant for this week's video in terms of longer term thinking. I will say this though, that Exxon is kind of ready to come into some resistance. You can see that there would be a gap fill here around 83. That's really where this move down began. and the downtrend line comes into play there. So I would be looking for some type of a move here. If there is, it would be a good right or right out short for Exxon. If you're long, if you bought this, the 80 getting close to 82s, 83s is probably where you want to start to lighten up. But I do believe that oil is trying to bottom. I think that it would probably have some type of a pullback and then a move higher. If it decides to pull back right away, the 75.98 is really the key. That was the breakout. So if there's some type of a move here, you might want to be looking to kind of play by the dip here, or if it rolls over sooner, you could play by the dip here as long as it's on the, this would be a great confluence of events if it happened right on the trend. So we'll see. I have to see how that winds up playing out. China is always, as you know, key. It is good that this week did break out. They reopened. They had been closed for holiday. This sort of was looking like a bit of a rollover, but it was a gap. I think it caught a few people. It's 3 days here. Anything above 37.66, I think, is still kind of good for the bulls. If it rolls, if that breaks, then we'll probably wind up being back lower into, maybe to retry the trend line. But the good news for the bulls is that they are starting to make some higher highs off of higher lows. And that, I think, is fairly constructive. It looks like maybe there's a bit of a new channel forming, and FXI might be kind of trying to steer the ship. I don't even really need to see FXI really rally that much, but you just don't want to see Shanghai and China really fully collapse. That really could get things going here again to the downside. You really need to see that stabilization. I added a 6 key, and this is maybe becoming, believe it or not, one of the most important of the 6. I may even move this thing up. This IBB, because this is a big component in NASDAQ, and believe it or not, also in the Russell. IWM has a lot of small cap biotech exposure, and if this is weak, it can pull those leading type of indices down. I'm going to show you this on a bit of a longer term time frame, though, because where we are is really important. Look where the breakout took place, the 275.40, roughly around that area, and once we kind of firmly got through the 280s, like this $5 range from 280 to 275, that's really where the big bull run came. And the flash crash low took us kind of low there to the 84s. But we rallied back up. This was sort of, a head and shoulders top. It sputtered, it broke, it had the check back, and then broke down really hard again. So this is really a little more bearish, I would say, than the overall market, because look at the severity of the move back down and the lack thereof of a bounce in just these multiple days of consolidation. If you look at this chart and you don't really have a bias, I at least think that the next move could be even still lower, maybe even to fill up this range here to the 260s, really where there was a gap here, which got this move going. So it's possible, and that's also mid-range here of where the breakout took place if these lows fail. So I like put ratios, again, for that type of a play. Those are the best to fill when they're coming down. But that could be another leg here with the IWM, and you have to be really careful with that, because I believe this is sort of the tail wagging the dog, where the ETF, so many of these stocks are so loaded in the ETF that forced selling in the ETF is forced selling in the stocks themselves. And I think you all know that Gilead is basically the kind of the poster child for this type of action. And you can see it. The bounce has been, this never got as weak, like the IBB got that low, but Gilead isn't sort of really not bouncing that much, although it did make a bit of a higher low. I do like a retest of this level here. You can see on a longer term breakout, 84, 85-ish was sort of where this V kind of took place, this like inverse head and shoulders, if you want, where this rally kind of took place. So I would look for right or right out here. If that failed, it's sort of a GTFO, because it could easily fill up, believe it or not, even down to 65 or 60, where the 61.8 fib is. A 50% fib is obviously 72s. I don't really see anything there other than this sort of middling line here, so maybe that would be it. I would like if this were to break on earnings or something, I would love to buy this put ratio and those puts and sell these. For now, though, I do think that this 84, 85 level will be defended, at least for right or right out. If it breaks, just get the F out of the way. But I do believe that will set up. So let's look at some of the momentum stocks. So Apple, let me get you into a more or actually this time frame is good because this really shows where this came down to. So I had been saying that I thought Apple a while back before this move all happened could see the 95s and maybe 85s and potentially even lower to the primary trend line. The good news for the bulls is the longer it takes, the higher this primary trend line moves. But you can see we had the flash crash low. That got down to 92. And it's rallied up, and it's just been sort of weak and listing for a while, and it broke down, and then here it's trying to rally again. It's all in the context of a downtrend, though. And it's all in the context of reference areas that had been prior supports, which sort of failed, and now they're kind of like being retested again. I've said for a while the key to Apple is this gap fill here. This was where the earnings gap took place, and this big move took, sort of the big top took place. This like arcing, it's just sort of worked its way to a top. So this 109 is really key. If it loses there, I think this 103 breakout area becomes key. The old high from way back in the day was 100.72, and then then we're talking fibs. So Apple's earnings are coming up. There's a lot of sort of fear around China. Yum just got itself demolished. I don't know if I really want to get into that too much right now. Maybe I will. But they did pretty crappy. You can see this is really what happened. It gapped down really badly. There was some reference supports down here in the 64s and 65s. It stopped just ahead of them in 66s. But this is a pretty big move, and this was mostly on China news. So that's really why I think Apple has been. A lot of these stocks have been under pressure. We know Nike reported they were good, so that's going to be really key. Apple, I did say here though, that it felt like something was going on, that this should have, according to my dope, should have broken down to the 107s, and it was just sort of intraday listing around, and it wound up, I had said on the stream to be careful if you were short, and that I thought that the trade, really, I've said it a few times, over 109 I think is long, and you could see where this really closed 112. So I do think that there's some potential move up here to the downtrend and to the 50 and 20-day moving averages. If you're bearish, that's a good right out short. If you're bullish, you might want to just be kind of waiting and seeing to see if that can snap. If it does, then I think we could come up to the range top, close to 117. 115 has been a key level, so 115 to 117. And then maybe even up to the 119.75. We'll have to see. I'm a little bit, if I had my druthers, and I know most people don't want to hear this, but I would love it to come up to here and then really fall apart and come back down and retest this area and do what I affectionately refer to, and my homage to Talladega Nights, is a shake and bake, meaning you shake out all the weak hands and then you bake it back to the upside. So that's sort of what I would love to see, a shake and bake situation in Apple. Amazon, if you think about this as a big bull flag, although this kind of did get a little bit jiggy here, we are forming a bit of a pennant here with higher lows. The highs are starting to eclipse each other, but the pattern obviously I think still looks a little bullish. They do have earnings coming up. I like to be opportunistic on these, particularly when the moves are down, to like sell some puts after a couple of days, because usually at the very least there's an attempt to try to get into the gap. Also, there's a trend line, see, from the gap that's held for a while. I wouldn't mind seeing this move back down into these reference lows, particularly if it's like right on the trend line near these sort of references. That to me would be the best scenario, but it is looking sort of sideways. It's not showing its hand too well. I think Amazon is probably going to resolve higher, this is all depending, assuming the market still does go a little bit higher, but I do believe the better play for Amazon is going to be to wait till after earnings and be the second mouse, just because the price is compressed for so long, and I'm expecting a really violent move. Google also kind of looks the same way, although this one looks a little bit more bullish, just because of the pennant price, the channel price action. I drew in an artificial channel here. The lows have been a little bit more not respected as much as the highs, although you can see, look where most of the price action took place. This did fill the gap, but look where these bodies kind of stopped. It was right above the breakout. So I do believe that if this were to come down into earnings, it could set up for a long. If it really winds up running ahead of time, you might want to be a little bit more cautious. But the pattern for Google to me just looks like a lot of chop and consolidation and all above the old highs, which to me is still fairly bullish. So Google, I think the pattern there looks okay. Facebook, kind of similar. I mean, I hate to sound like a broken record, but look at these, this sort of just consolidating. I mean, they are in slight downtrends, but they're not really in like severe downtrends. They're just sort of consolidating up at highs. 92.54, which was this is really the kind of the Mason-Dixon line for me with regard to long above and either not long or short below. You can see here they tried breaking down below that area a couple of times. Here they actually succeeded with a close just below, but then we were right back up. So look where it held though. The body, the body was above the 50. This one also the body above the 50. Was the 50 you can see here was resistance. Now it's kind of finding support. I think that the answer to Facebook is just going to be you want to be long above the 50-day moving average, and you don't want to be long below the 50-day moving average. It's really that simple. I do think that this is a little bit I wouldn't say interesting, but I would say that the stochastics here are starting to roll over a little bit. They're reporting soon. Facebook has been a serial sort of troublemaker with their earnings because of the currency issues. And we know the dollar has been strong, so I would like to actually see some shake and bake with Facebook where it kind of comes back down and lists back lower into the range, maybe even get a trend touch. I don't know if we're going to get that low. You can see the 72 really got back to the old top a while ago. I'll show you that on a chart quickly. 3 years daily. Look at the 72 here. That's really where this action kind of took place. It disturbs me a bit that we were able to get that low. The midpoints here, the 81 to 86, 5s, 86s, has been more the important range for Facebook, and the pullback low was only to 83, which is good. So I think that if there is some type of a pullback close to 83, and if it coincides with the trend line, that would be even better. That it's a buy for a long. Here it's again, this is just really just chop. Very hard to distinguish. Twitter starting to make some higher lows and some higher highs. I didn't even know that was still legal with Twitter. So I do see some resistance coming back up. We know Jack Dorsey took the helm here. I do think that there's going to be some people anxious to get their money back over here. There was some, kind of a buy the dip play, I believe a lot of people used against 35s, 36s, and that could become some resistance at least the first time around. So I'm just playing this. I actually have a little bit of a long in here. It's nothing major. The real question is going to be, I think their earnings, the actual earnings numbers have been okay. They were actually, believe it or not, as ugly and hideous as this sounds, their earnings were fine. It was just that the user growth was a problem. It's been very weak. I don't think that's going to be fixed for this quarter. So the real question is it hammer time again? And is the street just going to take this thing down? Or is it sort of understood at this point and they're going to get a bit of a pass and Dorsey's going to get a little bit of time to get things going? I'm a little skeptical. I think that it could be hammer time again. I'm a little bit nervous with that. So I would be careful if you're chasing long. And I would be looking to reduce size as this rallies up ahead of this print because it could be just like a one more move down to see how this goes. Believe it or not, this stock could be cut in half and still be very expensive based on their earnings because they have a growth multiple and it's a company with no growth. So I'm cautiously optimistic for Twitter. I think it couldn't go higher, but I am also mindful that if it comes into earnings after a multi-day run, that it could get, smacked again. So just be a little bit careful as this thing rises. Netflix, this thing was looking like a head and shoulders top. It kind of started to break down. It did this day. I was lucky to be short this day. I did cover. It was a smart move. And it rallied back up. I had discussed shorting it again up here. It worked again. But now it is just sort of being, I wouldn't say stubborn, although there are a lot of people in here, some real hopium people in Netflix, but we did come up to fill this gap around the 115s. I said I thought that this area now was sort of a no mas, that this is going to really depend on the earnings. This is pretty bullish price action, but, if you are coming back up into highs in this type of a market, it could get a little bit dicey. So I really want to see how this trades really just before there. If there's some type of a spike move up, then I think the play could be short. If it does wind up being, kind of just choppy and maybe comes down a bit, maybe there's a long to be had in there. Longer term, I've said this, and I know I've taken a lot of heat from some trolls on the stream, that longer term, it would not shock me to see this 70 retouched, revisited. You can see this is, believe it or not, still a bear wedge. As crazy as that sounds, you can see I kind of drew it in for you, but it is still a bearish pattern in the context. I mean, it's a bullish stock, but with a kind of a bearish pattern. So it wouldn't shock me, believe it or not, for this thing to do something like fall out of bed. I don't know if it's going to be this extreme, whether it's going to just be to revisit these lows, but I am a little bit cautious in this. This pattern, it probably isn't as bullish as people might think to first blush. What is bullish, though, is that the head and shoulders kind of is failed at this point. So it is sort of a bearish rising wedge, but it is in the context that this neckline isn't broken. So if as long as we're above 103.88 to 105, I would say, that is sort of like the tail line of the support that it needs to hold. And you could see the 50-day is key. That's around these 109s. That level has been important for a while. So that's sort of like the range as you take it. I would love to do put ratios here. I probably will wait a little bit because this could move big on their earnings. You could see what had happened here the last time. I don't like getting caught up in those types of things. I'm more of a second mouse, particularly with stocks like Netflix, although I had played Netflix long. I did it with a call ratio. I don't really want to get too into that from back in the day, but it wound up being a nice winner. So I'm a little cautious with all these stocks, but this one in particular could be this could be a little bit troublesome. It is sort of bending up, but I don't love that it's in the wedge, and we have to really see how it handles this 115 area. If it fails, if this big range, this reversal range, this was the day they announced their price hike. This is the key. If you lose if you lose the low of this day, look what happened. You looked below the neckline and then rallied up and closed basically at the gap fill. That's kind of craziness, and that's not even on earnings. So this range here to me is really the key. I love that Friday was a kind of a doji. This is rather bullish. It could still squeeze, believe it or not. Holding and consolidating here is bullish. I would use the 50. If you're long, just use the 50 as the stop. That's my opinion. It's roughly about halfway in the range. So, if it pulls back here, you can try right or right out long based on the 50. If it fails, you can try, a short maybe for a move to the lower end of that range. And if this loses this day's range, this is I think, going to collapse. So this day's range here to me is really the key to Netflix. Above the range is bullish, below the range is bearish. Let's keep it simple, stupid. How's that? Price line. Looking bullish, but look at how many days it's rallied ahead of the print right into resistance. So I would be really careful with this. The ideal scenario would be for me is for this thing to kind of pull back the next few days ahead of this print and then set up for a long. You can see it is making higher lows, which is good. The highs are sort of low. They're lower highs, higher lows. It's compressing. This thing is going to be a ginormous move. We'll have to see how that goes. I would be a little cautious, though, it is starting to break the downtrend. If this keeps going on a continued squeeze, then I think it could, believe it or not, set up for a short for earnings because it'll have rallied so many days ahead. If it got up into here, then, that to me would get a little bit more iffy. So I'm cautious with this. I really am curious to see. I would like to do put ratios on this. Buying puts here and then selling still lower puts into the middle of the range for a pullback. That would only be ahead of earnings though, for series that expire before earnings. Tesla would help if I could type sometimes. Tesla is pulling back. Look at where we are. The trend, the primary trend is held many times, particularly here with a bit of a look below. So we are getting a little bit close into that area. I did draw a bit of an artificial trend line here. I had said that I thought we would rally up to the 265s. It actually rallied up above there. I've never really looked back since then. And I did say that the 242, which is where Elon Musk did his secondary and bought in, was the key to hold. and it's failed. I said if that failed, we could see the 224s to 221s, which we have. Now this is really the key here. We're on kind of the channel low. This 115.51 is really the low that you need to hold. If it loses there, just GTFO, because then I think you're going to come down and retest maybe the 204s, 205s, which is another Fibonacci level from a while back. It isn't in this sequence, but it has been in a larger one, and it also has been some reference ranges, maybe to retest the 195s and then the gap fill of 191. So I'm a little bit cautious. I like put ratios. Look how many days it's been down. I like put ratios with a sort of the lower strike being around these 204s, 205s. And then maybe it comes down, and then you kind of could maybe even reverse long for a move back up. The more it moves down into the number, probably the better it sets up for some type of a bounce play. But I just think that this was a little bit of sell the news. And Tesla, I do think longer term is probably destined for higher, but it might be lower first. We have to see. This day is really key. If this gets lost, then just be careful because you're below the channel. But maybe it does wind up doing something like bouncing back up higher. I'll go to WYNN. Look at this move. This is a textbook professional gap. Look at this. How many days down, 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 getting close to the breakout range I had discussed. This 43s. We never we never fully got there, but we did get to 50. And look what happened here. I want to just show you this because when you see this pattern in the future, you know where it's going. Look at this. It's a gap up and go with a Maribozu candle, which just basically means you open on the low and close on the high. Very little wicks, if none. Above the downtrend line, and then the pullback here held above the 50% pullback, and then it just went. We are coming into the 50-day moving average and also some reference areas here. So there might be some sellers. I do think that this stock can see 100 again. I just don't know when it's going to be. If there were to be a pullback, I'm going to show you this. And just by my eye, I haven't even drawn the retracement in yet. I'm guessing that somewhere in between here, this area should be like the 50 to 61.8 of the move. And I would be an interested buyer. I would like to do put ratios for some type of a pullback move there. Yeah, look at that. To the tick, 50% fib. So, and look where the pullback was here, the 61.8. So I would like to do put ratios with these somewhere down here with 63 or 60 being the lower strike. And then, not so much to play it short, but even to get long here at a better cost basis. So if there is some type of resistance and it does wind up pulling back, I'm an interested buyer in here for right or right out trade action, and I do like it for put ratios. Anyhow, that is WYNN. A longer term, like I said, I think can go higher to retest up here to close to 100, but I don't know if it's just going to be a straight shot. It just might be, a long and windy road just because it's moved a lot already, and there could be some room for pullback. I'll end on some of the silliness with the GoPro. I had said I thought we were going to see these reference lows. We did. You had a sort of a downgrade. You did have a downgrade here from Morgan Stanley. It wound up closing kind of above the low. It was sort of a look below and fail. Then the next day there were some more downgrades with a move down. It was sort of an undercut, but didn't really get the you'd think there would be more bearish action. I love these downgrades at the dead lows. These people are absolutely clowns. It's the same kind of people that upgrade at the exact highs. They downgrade at the dead lows. And then Friday was a little bit more bullish earlier, but it still did close above this day's range. So if you want to use Friday's range as a barometer, above the range is probably a long, below is probably either a GTFO or even maybe a short for a move still lower. But I'm starting to turn a little bit on these. Longer term, I think this stock is going to single digits, but that's another story. I love people that are, give me criticism because I say I think single digits. All the way up here, I was saying this, and it's not there yet. So I'm a total idiot, right? But anyway, this is just how people work on Twitter. So there could be some type of a pullback. Sort of a bounce back. This has been a really steep move. It's starting to level off a bit. It's rounding out a bit. So I would be I'd be looking, believe it or not, more short term to play this long for a bounce. This Ambarella still kind of in crash mode here. This bounce sort of failed. If you want to use this day's range over the kind of the failed bounce, this inverted hammer, I think you can play long. And then below this low, I think could crack. The longer term support in Ambarella was really the breakout here of this 36s. I realize that that's still a long ways for us. It's down near where the trend line is. That would be, believe it or not, the best move for this thing to come back. Just take back all of this blow off. Just get back to here, and then that could set up for a great right or right out long, maybe even sell some out of the money puts. It's sort of starting to look like it might be rolling over again here, but there are some, like I said, I've said this on Periscope, I don't go to max range immediately. Look, 48.5 here is a support level. I would not want to be short the first test there. There's another one down here at 44. These levels can hold, believe it or not. Things can turn before you get the max extremes. So just because this is rolling over doesn't mean we're going to get here automatically. Look at this. The stochastics are oversold. They're actually starting to turn back up a little bit. So I'm not a fan of shorting, pressing lows on stocks, but I will say this, that this was, a few days up here taken out by one big, engulfing day. This to me looks a little bit bearish. That has me a little bit more cautious on the GoPro call. So keep those things in context. Anyhow, I'm going to leave it at that. Be sure to follow me on Twitter. My handle is @JustinPulitzer. If you like this video, just click the thumbs up arrow below. You can leave some comments. If you're not subscribed to my channel, just hit the subscription button. You'll get updates when these videos are posted. You'll also get the Periscope rebroadcast as well as special edition videos. That's my story. I'm sticking to it. Let's have a good week, and cheers.